Welcome to our next video within ACCA's FA2 paper, Maintaining Financial Record. This video will be about partnership accounting, an issue students normally don't like, primarily because they don't really understand what partnership accounting is about. They don't really understand the need to split the profit of a partnership, but that comes from lack of awareness of how things work business-wise, and that is what we will try to explain here. So, normally, when a partnership makes a profit, a partnership is not a company. It is just a business owned by individuals, and each of them contributed some capital, may contribute work, and they definitely signed an agreement on how to split profits. Alright, so they all contributed some capital. Some of them or all of them may contribute some work for which they will be remunerated. However, because it's a partnership, their salaries will not be treated as salaries expense. Their salaries will be the appropriation of their profit. And finally, they must have decided on how they will split that profit. So let's say we are in a partnership that decided the following. Well, first of all, they said that they are entitled to interest on contributed capital. To the amount of 10%. So, if there is a profit in the company, first, that profit is split by calculating 10% of the contributed capital by each partner. They also said that partner number 1, and their names are Rag, Tag and Bobtail, Rag, Tag and Bobtail, and they also said that Rag is entitled to a salary because he actually works for the company. Tag and Bobtail don't really do any work for the company. They just they work somewhere else, but they contributed the capital there. So Rag is entitled to a salary of 10,000 each year, and that also counts as an appropriation of profit. And finally, they decided on the PSR, the profit sharing ratio of 40, 40, 20. And now let's assume their business made a profit of 80,000. Now let's look at their financial records. From previous years, we will see that they have a capital amount, which is basically how much they originally contributed, or how much they contributed, and current accounts, which is the product of prior year profit split minus drawings made. A drawing is when a partner takes a little bit of cash to him or herself. The accounting for drawings is that simple. It's debit current account of a given partner and credit cash. It's an equivalent of paying a dividend in a company. So from prior year we have the following balances. As you see, Miss Bobtail is what we call, she is overdrawn. She took more out of the business in previous years than her entitlement. However, now we have a profit of 80,000 that we need to split between partners. So first we will take interest on capital. We know it's going to be 10% of the capital contributed. I'll try to erase things that are not necessary right now to keep everything clear. So we will have 10% of that, 10% of that, and 10% of that. That will add 14,000 here, 18,000 here, and 2,600 here. Until now, we appropriated 34,600 out of the 80,000. The next thing is the salary. Well, Mr. Rag is entitled to a salary of 10,000. So that's how we appropriated another 10,000. And finally, whatever is left goes according to the profit sharing ratio. Now, the amount that is left now is 35,400. That is simply 80 minus 10 minus 34.6. And that will be split in the following way: 40% here, 40% here, 20% here. So it's going to be 14,160 here, 14,160 here, and 7,080 here. So overall, after all these manipulations, Mr. Rag will have 90 plus whatever was apportioned this year. Mrs. Tag will have her 72 plus whatever she got now, and Mrs. Bobtail will have the 3,000 plus whatever was appropriated now.